All right, so I made a video last week about BTCI, that is the NEOS Bitcoin covered call fund. I wanted to make a video today about YBTC, which is one of the Roundhill covered call funds. Now, Roundhill is known mainly for having weekly covered call funds. Now, most are monthly payers. This one is weekly. They also have XDT, QDTE, and RDT, which are also popular. Those ones have all slightly underperformed the market, so I'm not as big of a fan of those, but YBTC has outperformed the market, and I like it. So first things first, if you get value out of the video, please like and subscribe. Check out those links below. So getting right into it here, this is the prospectus from Roundhill, basically saying YBTC utilizes a synthetic covered call strategy that seeks to provide current income on a weekly basis, while also providing exposure to the price of Bitcoin ETPs. So they're a little bit different. So synthetic covered call funds, they're good in some ways, they're bad in other ways, right? The biggest drawback to MSTY, for example, obviously that's a yield max product. That one's also a synthetic covered call fund. Now, a traditional covered call fund, they simply own the underlying stock or index and they sell calls against it. Very simple. Synthetic covered call funds, quite a bit more complicated because they typically do not own the underlying asset. What they're doing is they're trying to replicate price returns. Now, when times are good, synthetic covered call funds will outperform, probably quite significantly, right? I mean, MSTY has paid a dividend as high as like $4 a share, which is like literally like over, I believe that's over 200% dividend, at least based on its current pricing. Now, the problem with that is with synthetic covered call funds, typically you get share price contraction, at least especially when times are bad. With traditional covered call funds, yeah, the price is going to go down a little bit, but to be quite honest, traditional covered call funds, typically the best time to hold them is when the market is down, because if the market's going down and you're selling calls, well, that's easy money, right? That's easy money because the problem with traditional covered calls is when the market's going up, you're missing out on some of that upside. So when it comes to the whole synthetic covered call versus traditional covered call strategy, I think they both have their place. I don't think that one is necessarily clearly better than the other. They both have their place. When it comes to synthetic covered calls, though, it really comes down to how good is the management team, because you got to be good to be able to make that work. So again, they do own some underlying ETFs, being IBIT for this example. So that is good in some ways as well, right? In that they're not entirely reliant on the calls. But if we get right into the comparisons here, let's check out YBTC. So like I mentioned here, the big draw towards these funds is the weekly payments. The weekly payments are very nice because you're getting money every single week. Every single Friday, this shows up in your account. And when you look at the current dividend, the dividend this year has been as high as, I believe, 56 cents a share was the highest it got, and the lowest it got was just over 20 cents a share. So on the low end, the dividend, you're looking at probably 20%. On the high end, probably about 60%. Based on the last dividends have both been 27.5 cents a share. That's about 29%. So very good, right? I mean, if they could, if I could get if they could continue that, I would take that in a heartbeat because it's a 29% return, right? Now again, you have to be careful with the share price return. So let's check that out. So with YBTC, this fund debuted in it was actually January of 2024. So it's been around for almost a year and a half now, a little over a year and a half, and the share price it's basically flat. It's up 47 basis points. But when you account for drip, like with the drip returns, you're up 97%. The S&P is up 33%. So you've almost 3x'd the S&P during that time. So that's very good, right? Honestly, I don't know how you can complain about that. Now, to be fair, MSTY has outperformed. And also, BTCI has also outperformed since its inception. So it's tough to say. When it comes to these ETFs, my position is quite simple. I simply buy a handful of them because there always is a chance that one of them or two of them goes belly up, or at the very least underperforms, and you end up having to sell it. So my position, always, you do want some diversification. When it comes to my ETFs, just straight up, I have a pretty clear top 4 right now. Now again, this could change next month because there's new ones coming out all the time, and I've had ones in the past that I like that ended up underperforming over a longer period of time that I got rid of, or at the very least lowered my exposure to. But when it comes to the top ones right now, it's MSTY, it's MSTE, which is this is the Canadian covered call. They also have a Canadian MSTY, but MSTE uses a little bit of leverage. They've performed very well recently, so I like them. And I don't have to pay the tax. As a Canadian, you have to pay taxes on U.S. dividends. Now again, the dividends with these are so high that frankly I think it's kind of irrelevant. Like, let's say you're getting that 29% return, so essentially you're getting like 25% return. To me, it's not really relevant. I'm still looking at overall returns. So it's MSTY, it's MSTE, it's BTCI, and it's YBTC. Those are my favorite ones right now. Like I said, that easily could change, but those are my favorite ones right now. So if we look at year to date, let's just go year to date just to compare all of them, and then I'll kind of leave it as is. So year to date, YBTC, the price returns are actually slightly negative, which is kind of weird because Bitcoin's actually up, I think, fairly nicely on the year now. So that's a little bit concerning, but I mean, MSTY is also down a lot more. So you got a 27.62% return year to date, negative almost 2% price return. So let's compare to BTCI. I'm not going to compare to MSTE because they've only been around for like 2 or 3 months, so it wouldn't really be relevant. So let's go year to date on them. So BTCI has had very good price returns, 8.5%. BTCI's price returns have actually outperformed the S&P just based on its price returns, which is very impressive. 25.82% drip returns. So it's slightly underperformed. We're talking less than 2%. So it's given that it has had positive price returns, I almost prefer this one because BTCI clearly is safer. If you want the safer fund, BTCI clearly is safer. The dividend's about the same, right? But BTCI clearly is safer. The expense ratio is exactly the same. It's 1 basis point different, so that's not going to change anything. So BTCI definitely is safer if that's what you're going off of. And then let's compare to MSTY just to finish things out here. MSTY year to date. So negative 16% price returns, although it's up 38%. So what is my conclusion based on this data? Number one, and this is the most obvious point, it should be the most obvious, MSTY is clearly the biggest high risk, high reward play. It is the most risky, but it's going to give you the best rewards, clearly because it has performed the best. BTCI clearly is the safest because it's the only one that has had positive price returns, and it's still returned 26% when you're reinvesting dividends. YBTC is kind of a hybrid because it's clearly safer than MSTY, but it's not as safe as BTCI. So, long story short, my position still remains the same. My largest position is still in MSTY, but I am closing the gap, right? I would prefer that these 4 funds are fairly close. My largest position probably always will be MSTY, assuming that it continues to perform how it's performed. But on the flip side, I do want to make sure that if MSTY goes belly up or BTCI goes belly up, that I don't get completely wrecked. So that's my position on YBTC. I think that it's a good fund, and as long as it continues to perform well, like I said, the last thing I'll leave it on here, I guess, is something that I didn't bring up yet, is that my comparison is always, will it outperform the S&P? Not that you're buying the S&P for dividends. That's not the point. The point is that there are always going to be funds that will outperform the S&P. So why would you hold funds that underperform? Even as far as dividend focused funds or income focused funds go. So that's my point of view there. And I say that because there's more and more of these funds all the time. Like 5 years ago, I'm pretty sure like when you're looking at like covered call funds, or it was basically like QYLD and XYLD. Like that was pretty much the only game in town. Now there's literally hundreds of these funds. And I mean, if you look at Roundhill just in like the last, couple months has came out with numerous funds, right? I mean, AAPY is new, AMZY is new, like pretty much all of these are new. Pretty much all of these are new. I think PLTY and NVDY have been around for a little bit. That's the last thing. Now that I think about it, I actually just thought of this. I really hope they come out with an MSTR weekly paying fund. Honestly, I don't know why they have not done that yet, because if you look at the Yield Max funds, I believe MSTY is their largest fund. Like it has $5.5 billion in AUM. So why they haven't done that yet is really beyond me, because I would buy that. I would buy that like the day it came out. I mean, the day I found out about it, at least. So anyway, like I said at the start of the video, please like and subscribe. Check out those links below. Always appreciate the support, and stay tuned for more.